Hello, everybody. It's August 3rd, Monday, 11 a.m. here in Long Island, and it's a very rainy day. We're looking forward to a fairly rainy week. So this summer's been a little bit of a washout. A few days too hot, other days perfect, and now the washout. Max is here. Max has actually figured out how to train me. I give him a treat to join us here because sometimes that's what it takes to have him appear, and I know how important it is for many of you that Max attends. And as you can see, he's not sleeping now. He's wide awake. And I think that's because he's expecting another treat. And if he doesn't get it, he's figured out how to train me. He leaves, and then he goes kind of lies on the floor over there off camera, and then I have to give him another treat to get him on. So he's got me trained in a Pavlovian method here. So he's a smart dog. Um, well, let's see. Lots of smart things to talk about. Not so smart was this fellow Leo who ran situational unawareness. I think it's the proper name is situational awareness, and I can't pronounce his last name. I can't remember it. Long names are hard for me to remember these days. But Leo was a young fellow who apparently was at OpenAI, and he figured he could make a lot more money if he opened up a hedge fund to trade on what he knew about the AI trade. And he was a big believer in trading on the infrastructure. So he was long the semiconductors. Apparently, he was short the software stocks, and worked great until it didn't work so great. Kind of blew up last week, and Citadel swooped in and bought it all. Obviously, the big discount, but I kind of view that as a confirmation that the AI trade makes sense. If Citadel, uh, granted at a discount, got themselves a pretty good deal on this uh, situational awareness hedge fund, then they wouldn't be buying it if they didn't think there was upside. Then again, the discounts could have been substantial, and it was a no lose kind of situation. But in any event, it probably contributed to the volatility of the market last week. Maybe some trading desks got wind of the situation. Obviously, they had to because there were margin calls, and somebody decided, I guess the people who provided the margin, they made a decision that it was time to close this fund and to sell it out. So that undoubtedly contributed to some of the volatility. As you know, at the beginning of June, we called it the June swoon. And then in July, we started to combine June and July and August and call it the summer stall. And the idea was that earnings were going to be fabulous earnings momentum. FEMA would rule the day in terms of the earnings seasons. But the problem is the market, the analysts were already discounting, had great expectations for earnings. So how much better could the earnings actually be delivered? So the upside of better than expected earnings would be somewhat limited because of the heady expectations. And at the same time, we perceived that the Fed would remain in a tightening stance. We actually thought that they might raise the Fed funds rate at the July meeting. They didn't listen to us. And as a result, the bond vigilantes kind of stepped in. They didn't listen to us in 2024. We told them you cut the Fed funds rate by 100 basis points. The bond market's not going to react well. And sure enough, bond yields rose 100 basis points. Didn't listen to us last year. They cut the Fed funds rate three times, told them the economy didn't need it, and the bond yields didn't budge. They stayed elevated. And now we got the 2-year Treasury note uh, basically telling the Fed you need to reverse all three cuts last year because the 2-year note is basically discounting three rate hikes over the next 1 to 2 years. So that's the predicament the Fed is in. I can't quite figure out what's going on with Warsh. Maybe Warsh couldn't get the votes to raise rates by a quarter point. Maybe he wanted to, but he didn't want to join the dissenters because it'd be kind of odd for the Fed chair to be the fourth dissenter, and that he couldn't convince the majority to go ahead with a rate increase. Then again, another thesis is that he was appointed by President Trump. President Trump wants interest rates to decline. He certainly doesn't want to see rates going up. Maybe Warsh and Bessent have convinced the president that in order to bring bond yields down, they have to raise short-term interest rates. Whatever, it's the other possibility is that the midterm elections are coming through, and the Fed's supposed to be non-political. But then again, Warsh was pretty political in trying to convince the president that he was the right guy and that he would lower interest rates. And instead, he comes in and starts talking about tightening. President couldn't have been very happy about that. And let's not forget that one of the reasons that Trump basically, how can I put it? I can't put it delicately. He just downright hated Powell, and he hated Powell because Powell lowered interest rates before the presidential election, and obviously Powell uh, was set up for all sorts of trouble as a result of that. And the president was in revenge mode when it came to Powell. And Powell's still sitting there at the FOMC. He should have retired by now. I think he's waiting for his case to be resolved. But at any rate, Warsh may figure that he doesn't want to push his luck and raise the rates before the midterm elections. So that's a possibility, in which case he's kind of counting on the bond vigilantes to do the heavy work. Well, they're doing it. Uh, Meanwhile, the stock market doesn't seem to be particularly alarmed by any of that. Shouldn't be alarmed as long as a 10 years somewhere between 4 and 5%. I think that's the normal range for rates. We're back to where we were before the great financial crisis. We're back to where we were before the we're back to where we were before the great inflation situation. 4 to 5% yields are reasonable yields, in my humble opinion. Now, the other thing, of course, that's new today, over the weekend, President did a taco. We're negotiating once again with the Iranians. Trying to, the president obviously wants to get this thing over with. The Iranians, well, who knows? There's probably a contingent of people who do want to get a deal done. But then there's the IRGC. And, 2 days into the war, I went from thinking that it would be a short war to concluding, well, wait a second, what about the IRGC? These are professional terrorists that basically are running a country. They're not going to be interested in surrendering or giving the president what he wants. Let's not forget where the Satan as far as they're concerned. So we'll see. Market sort of gotten used to the idea of the price of oil fluctuating up and down. Today it's fluctuating down because of the renewed discussions between the U.S. and Iran. And that's obviously helping the market go up. So this is all consistent with the summer stall ID. We're back above 7,500. We went above 7,500 on May 14th, and we're still there. I think this could continue through the end of August. We've got a lot of anticipation of what Warsh will say. Maybe I'm wrong about that. Maybe we've all figured out that there's nothing to anticipate when it comes to Warsh, that he's basically going to, not make any relevant comments and let the bond market do the heavy lifting. Uh, but there will still be some anxiety, I presume, about the AI trade. Maybe the washout of situational awareness marked the bottom in the tech sell-off. Tech has gotten to be awfully cheap when you look at the forward PE of the technology sector. It's back to the same forward PE as the stock market. The semiconductors are selling at a 15 times forward PE. By the way, South Korea is selling at 4.5 at a 4.5 PE. So it's really cheap. So the problem is not valuation. Remember, it wasn't too long ago, maybe a few months ago, when people were comparing the current situation to 1999 tech bubble followed by the tech wreck. Well, from a valuation perspective, that doesn't look like anything. The current situation doesn't look anything like what we had back then. Let me just look at my notes here. Oh yeah, the manufacturing PMI came out, and as was suggested by the regional surveys, it was very strong. The prices paid was down, but still elevated. The employment numbers were actually pretty strong. So all the manufacturing indicators are coming out showing that between the AI boom and onshoring, manufacturing is in fact making a comeback. Let me see what I'm doing here. Should have, and I don't think I wanted to do that. I have to do a share. So where's the share? Oh, there it is. One of these days, I'll get the hang of this. Okay, here we go. Okay, so in theory, and I think in practice, you should be looking at our charts from the morning briefing, August 3rd. Let me know if that's not the case. I have a couple of questions already set for our Q&A. But yeah, always give me a heads up if the sound isn't right or the video is not right. But I think we're okay. So the GDP numbers came out. They weren't disappointing because they were expected to be weak. The Atlanta Fed got it, nailed it. The Atlanta Fed GDP model said 1.5%, and that's exactly what came in for the second quarter. And the so at first brush, obviously some of the pessimists jumped at it and said this proves that the economy is slowing. That the pessimists have kind of latched onto this K-shaped economy idea that the rich are getting richer, the poor are getting poorer. Real disposable income has been flat for a year, yet consumption keeps going up to a record high. How long is that sustainable? How long can real consumption go up to record highs when real disposable income is flattening out? Moody's has come out with some study, which I just doesn't make any sense. It's just, I mean, at some point you got to start with common sense and then do the data analysis. But the Moody's analysis is something like 10% of consumers, high-end consumers, obviously, do something like 50 or even 60% of consumption, which makes absolutely no sense. Just go to a Costco, just go to restaurants, go to a Cheesecake Factory. I mean, the places are absolutely mobbed, and it's not the hoi polloi and the 10% of the wealthy that are doing all the consumption. It just doesn't make any sense. They don't eat any more than the rest of us. Yeah, they got some fancier cars, but how many cars do they really have? Once they have their house, they have their house or a couple of houses. Anyways, we've been promoting the idea, of the alternative idea that the economy, well, everybody agrees it's AI powered. There's only the kind of question of whether how long that's sustainable. And the answer, in our opinion, is for a while. Um, and then there's the question of then the alternative is the G-shaped economy, which is a generational concept based on my observation from my family, from friends that we have, relatives, and that is the baby boomers have done extremely well. They're sitting at a tremendous amount of net worth, and they are helping their kids. So the real affordability issue is for the kids. Made a little list here. We wrote about it in the morning briefing of all the things that the baby boomers don't really care about. They don't care about interest rates. They don't care if interest rates go up because they have 60% of money market funds. So for them, higher more short-term rates, bring it on, baby. It's just more interest income. They don't care about the unemployment rate. They're retiring. What do they care? I guess they do care though if their kids are unemployed or aren't making enough to make ends meet. But as a result, they're helping them. They don't care much about mortgages either because they locked in extremely cheap mortgages. So as rates go up, they feel like they're really smart. They locked in the low mortgage rates, and as a result, they're in no hurry to sell their homes. And the kids do come visit. Maybe the kids actually live at home because they can't afford to rent an apartment, so they're not selling their homes, which in turn leads to higher home prices, which makes them feel even smarter. They don't have much in the way of consumer credit, so you know, if every now and then we get news about delinquencies going up, it's not the baby boomers. They are concerned about the kids and they're helping them out. Um, and that's these are not kind of trivial. Oh, by the ways, uh, these are all factors that I think have tremendous macroeconomic implications. So here we go. Real quick, we got real GDP growth slowing down. Oh my God, the K economy obviously can't sustain growth. Then when we actually look at the breakdown, we see that it had nothing to do with the K economy. Consumer spending is somewhere here. This is PCE durables. Where is it? Come on, you can find it. Uh, services. Well, it's in here somewhere, and I think it was actually, yeah. Well, final sales to domestic purchases were up 3.1%, and that includes consumption. Why am I not seeing it? Don't want to eat up all my time here obsessing about it, but the total should be there. We know durables was super strong. PCE goods, therefore, were super strong. Non-durables, this is a real GDP, so it wasn't a price phenomenon. And here's PCE services. The consumers are strong. And then the capital spending was very strong. The reason that real GDP didn't come through with strength is because total imports really shot up, and total imports means that we basically have an AI boom, and we don't produce everything we need for the AI boom, particularly some semiconductors and so on. So we import a lot of that, and that means real GDP is a measure of production, so it kind of weighed it down. If you look at the contributions, you see final sales of domestic product actually contributed 2.2. At least here, I've got the personal consumption. I'm really obsessed with this. There it is, right there, staring me in the face. It's like when my wife asks me to get something in the refrigerator, I go there and I'm just standing there like, where is it? Where is it? She sees me standing there and she comes in and right in front of my face. So there it is right there, 3.2%. I mean, that's not a K economy number. That's a strong number. So you can look at the contributions on your own, but you can see that offsetting the 2.2 increase in the contribution from final sales was total imports, which took away 1.5 percentage points. Here's the chart that a lot of the K economy folks misinterpret. This is real disposable income, looks kind of flattish, looks like it peaked, but at any rate, for the past year, it hasn't done much. Meanwhile, consumption keeps going higher and higher, and that looks to them to be unsustainable because the savings rate's going down, and how much lower can the savings rate go down? And our answer is it could go negative. And that's just taking into consideration the G-shaped economy, the generational economy, the one driven by the baby boomers. Obviously, disposable income is going to start going flat. Maybe it'll actually go down because all these baby boomers are retiring, and what were they making? 100,000 to 500,000, maybe more. Um, Obviously, the younger generation may benefit from that in the sense that they'll move up to their positions and get paid more. But I think since the baby boomers are such a large group cohort in terms of numbers, inevitably they're going to be weighing on labor income and depending more on their net worth, their household net worth, and maybe interest income. So that'll keep the consumption going. This is selected personal consumption expenditures contribution to real GDP. You can look at it on your own, but basically what we're seeing is people are spending uh, on services. They're going out for meals. Here's food services, accommodations, um, and services, as I said, and healthcare. And so a lot of it is related to the consumption by baby boomers. But again, they are helping their youngins. This is the retail sales weekly. That a lot of this might have been boosted by the World Cup and by the tax rebates, but we're still looking at a solid number of 8.1% as of late July for retail sales. You're probably tired of these charts. Maybe not. They're pretty. They're colorful, and we've shown you. We've added some more sparkle, some more charts that are pretty. This is the same thing, showing you the percent of household wealth held by baby boomers in total. So they hold 52%. You can see that's kind of widened to 52%. The silent folks, the older folks, are at 11%. So 63% of household net worth is held by seniors, mostly retiring people. And I don't think there's ever been anything like it. I'm starting to sound like Donald Trump. Um, then we've got mutual fund corporate equities, and they have 54%. The silent has 15%. So that's 69, almost 70% is held of corporate equities, and mutual funds are owned by seniors. This is the same thing for mutual fund shares. I think I got that here. Actually, this is showing real estate, but you can see the mutual fund shares. I think that's 60% of mutual funds are held by the baby boomers, and if you add in the seniors, it's the silence even bigger than that. And then what else here? Real estate. They own a lot of real estate. 41% of real estate plus 8 is 59% of real estate. I think we kind of got the order of these charts a little bit backwards, but you get the point. Here's money markets. Look at this. This is household money markets in trillions of dollars. And now I got the order right. This is money market funds by generations. The boomers have 60% of money market funds. So together with silent, they have 76% of money market funds. So higher short-term rates, they love them. Makes them feel better. Just gives them more income. Distribution of household liabilities. Let's go straight to mortgages. Mortgages. Look at this. They've paid off their mortgages. I mean, they have 18% of mortgages, 20% all told. And I thought we had consumer credit. See, I should come more prepared with these things. I think we mismanaged some of the order of these things, but trust me, the consumer credit was the same story. So, meanwhile, the economy is doing great. This is the regional indicator for the ISM MPMI, and sure enough, it came out this morning very strong. The non-defense capital goods orders are flying. And then we got the inflation problem that Warsh wants to study and wants to think about and wants to decide what inflation indicator we should be looking at. Well, why not look at all of them? And right now we have a problem in an area we never had a problem in, and that is electronic components, semiconductors, et cetera. The various measures of inflation are flying. Not this one, but at least 2 out of 3 are flying, and Apple and other consumer electronic companies are raising their prices because of that. Import prices of technology are increasing. And then here's the GDP deflators. Elias and I looked at them, and it's hard to see any reason why the Fed shouldn't be moving to tighten, at least for credibility's sake. And and again, I think the economy can tolerate it. It's not a 25 basis points for starters is not going to do anything terrible to the economy, but it is going to increase the credibility of the Fed if they had done it. Now it's going to be harder as they get closer to the midterms, at least for Warsh. So it's going to be a messier FOMC meetings up ahead here until the midterms. But you can see this is the total. If you want to look at an overall inflation number, it's the GDP deflator comes out quarterly, and that's not a happy number, 4.3%. Take out, let me make it a little bigger for my eyesight. Take out food and energy, you got 3.8%. The GDP deflators, personal consumption, we all look at it monthly, but there's also quarterly, and the quarterly are showing that ex food and energy, we're not close to 2%, we're at 3.3%. And then this is the various components of it. The durables, which tended to have a deflationary streak, has been boosted by tariffs. And we've got tariffs again this year as an issue. So they're 3.2. So you're not getting the downward pressure on inflation from deflating durable goods. Non-durables includes the energy and food services, again, well above 3%, not even close to 2%. The deflators for fixed investment, they typically, well, forget about typically. Right now, you got a problem with equipment, 4.8. Intellectual property is still low, but that includes software. Structures is 4.1. And then finally, goods imports. Let me jump over here to what do we have here? Let me jump actually here. What I like to do is also look at the quick takes, situational unawareness. Hedge fund blows up without blowing up the market. A little graphic here for you to make it dramatic. Tech stocks, we think they're going to hold their 200-day moving average. They're weak today again, so they're obviously still testing the 200-day. But some of the AI trade stocks, the hyperscalers, are doing better today. Software's been doing better of late. The broadening of the market thesis we've had still working out. The S&P equal weight outperforming the market weight. Our thesis that the 493 would show some relative outperformance is working out in relative and absolute terms. As you can see, the XMAG, the 493 is outperforming year to date. The mags and the SPY. Another indicator that the economy is doing well. Russell Wood 2000 is very sensitive to recessions. They would not be at a record high if investors were starting to worry about a recession. Another sense of area broadening. Bull bear ratio is kind of mixed, so neither here nor there. The monthly indicator in the consumer confidence index on expectations for the stock market remain very, very bullish. Well, isn't that very bearish? Well, I don't know. I mean, right now it correlates pretty high. This is the 12-month average of the above. It correlates pretty well with the trend in the PE. So if you're wondering why the PE is so high, it's because people just are no longer easy to scare about a recession being imminent. FEMO, forward earnings momentum, fabulous earnings momentum, is keeping the PE high, even as rates have gone higher. The PE, of course, for the S&P 500 has come down, but some of that is because of other income from mark to market. Meanwhile, as I said, you look at where we are now in terms of forward PE, information technology versus the S&P. Well, people were kind of worrying that this was going to look like this. Well, forget about it. It's looking much different than what we had during the tech bubble. Earnings, this was boosted, as we said last week, by Alphabet's capital gains in some of its investments, particularly SpaceX. We are increasingly looking, though, at Q3, Q4, which obviously the analyst expectations are not going to incorporate MTM, so those are still going up. The 2020, we're looking more at 2027 than 2026. Again, because there's no MTM here. This was an MTM increase, but forward earnings continue to move higher. Forward earnings across the board, small cap, mid caps, large caps, these are not being affected by MTM, and those are at record highs. And bond market, a lot of things driving it right now. Today, the lower oil prices are helping quite a bit. So that's a quick run through, maybe not quick enough. Let me do some quick Q&A here. I don't know why I have such a large audience. Why aren't you folks all on the beach, or are you doing this from the beach? Michael, because baby boomers and silent generations hold 110 trillion net worth, and approximately 20 trillion in money market funds, should we be more concerned about too many dollars chasing after too few goods and impending inflation? Well, yeah, that's a reasonable way to look at it. If the baby boomers are interest rate insensitive, other than interest rates going up, make them feel even better. If home prices rising makes them feel better in stock markets, yeah, then they're going to continue to spend, and they're going to share some of that with their kids, who will continue to spend. And we're seeing that in retail sales. And it's another reason to believe that the Fed just doesn't really appreciate how strong the economy is. Adam, is it odd the market keeps falling for these quote unquote deals? Iran, well, you're talking about the geopolitical deals. Iran is not talking to us. Trump just says that is happening, and he's the world's most documented liar. Okay, I make no political judgments when I do these things. I just wonder if and when the market will ever wake up to his lies. Uh, well, Adam, let me tell you something I learned over the years. Never let politics get in the way of making money, of investing. And the other thing I've learned is it's extraordinary how well the U.S. economy and the stock market do despite Washington. So that's kind of the way I look at things. And I kind of increasingly try to not to get emotional or all that concerned when it comes to investing and giving you my opinions on politics. And I think you all can vouch for me that I don't get political. I don't see any point in doing that. And I keep telling you, try to tune that out and focus on what matters. Obviously, Washington matters, but it's not the only not the only influence on the market. And then there's all of us who working stiffs who somehow or other managed to do pretty well. Why did the Treasury Secretary, oh, this is Adam again, why did the Treasury Secretary and Hassett both say GDP would grow at 5 to 6% in Q2? What do you think happened? Do you think they honestly believe the estimate, or were, or were lying? Um, you know, what's the difference between being lying and being a politician? I mean, politicians tend to exaggerate. Uh, I'd rather use that than lying, but um, yeah, I think they've been hyping things up, and the reality is different. But I could come up with a pretty happy story without exaggerating or lying. Um, wow, Adam's got one more. Are there risks to the U.S. economy given it appears the government is manipulating oil interest rates and currency markets while also taking active positions in equities? Has the government ever intervened in the free market like they have recently? That's a very good point. The market is obviously being uh, somewhat influenced by Washington, and there does seem to be the taco ID that Trump always chickens out seems to be still a relevant trading ID. When the market goes down, all of a sudden you see him saying that we're not going to attack him. We're going to we're in negotiations. So there's certainly something to that. But again, that's not that's not all that's going on here in the market and driving the market. Um, okay, I think Adam got got it off its chest. Now, Eva, hi Ed, despite the April 25th Liberation Day panic, tariffs don't seem to have any impact on consumers. Or the tariffs are not getting implemented, or we're not buying more expensive products, or U.S. producers are substituting with domestic products. What do you think is going on? I had a big cantilever umbrella that malfunctioned, and I only bought it a year ago. So I called the patio store, and they sent somebody over to fix it. And I asked them, have your prices gone up a lot? Um, so, well, we've increased them some. So I said, has that affected your sales? He says, not at all. Well, he fixed my cantilever umbrella, and I got a little insight. But I think some of the increases in tariffs have been passed through, and as a matter of fact, Amazon has announced that they're going to rebate some one way or another these the refunds they've gotten. The tariffs have been adding to government revenues somewhere in the order of 300 to 400 billion dollars. So, that's a substantial tax that has to be paid by somebody. And again, I think it just demonstrates the resilience of the consumer, particularly the baby boomers. And maybe not only are they interest rate insensitive. I mean, again, they like interest rates going up, but but it doesn't. They're insensitive in the sense that interest rates going up are supposed to weaken consumption. Well, it actually works the reverse with them. Maybe they're also price insensitive. You know. I don't know about you, but we're still going out to restaurants, and every now and then, I'm not a big fan of eating red meat anymore, but every now and then I do like to have a filet mignon. And what it used to be like $25, now it's like 30, $40, and we're still going out and we're still paying it, and the restaurant's full, and it just doesn't look like it's all the hoi polloi. Okay, finally, Adam, great session. Got to jump to another call. Thanks for your questions, Adam. Thank you all for joining us. Have a good week, and maybe you can just go ahead, take some time off for the rest of the summer. If I'm right, it'll be a summer stall, and maybe you won't be missing that much. Thanks, everybody. All the best.